In today's episode of Crypto Over Coffee, I'm talking about the dangerous times ahead for Bitcoin and crypto investors and how things might play out in the coming months, along with our usual 404 Logic Not Found segment and a ton more content here on the way, so make sure you stick around for all the updates we've got in store on the show. Now, if you like crypto, please subscribe to the YouTube channel and hit the bell notification button, or follow the podcast on your platform of choice so you get a heads up whenever we post tons of free educational crypto content and analysis without all the hype. And better yet, if you are a subscriber and you leave a comment on the YouTube video version of this, you will be automatically entered to win a random draw for a Keystone Pro hardware wallet. So, pretty awesome there. Finally, just a friendly reminder, please be aware of scammers across all social media and in the YouTube comments that are impersonating me to get you to reach out, to send crypto or share personal info. So please be careful and do not interact with any of these scammers in particular. We've got some Onyx Coffee Roasters La Palma Geisha today. Delicious coffee. All right. Now, the headline of this video says it all, but right now is one of the most dangerous times for crypto investors across blue chip coins like Bitcoin and Ether to all sorts of altcoins of all shapes and sizes. And many will make the gravest mistake in this time period, but more on that in just a second. First, let's talk about why now is such a dangerous time for Bitcoin and crypto. And it's pretty simple, really. It's uncertainty. Uncertainty because the traditional financial system and traditional markets are destabilizing, or kind of already destabilized, and the actions of regulators and policymakers who are tasked with fixing these things are growing more and more desperate in their measures to do so. As you well know, if you watch my channel, the fervent money printing of the last 18 to 24 months is sort of having its Isaac Newton moment now. What goes up must come down, an equal and opposite reaction. This money printing and balance sheet bolstering on the part of central banks around the world has created a colossal monster in the form of inflation and financial instability that is nigh impossible to control without dire consequences in the form of a full-scale recession. As the traditional equities markets came to a close on Friday this week, the major stock indexes were down several percentage points in reaction to significant poor earnings results from major companies, as well as increasingly aggressive tones from the Federal Reserve with regards to the actions they're going to take to combat inflation. Now, this to me says two things. First, it tells us that with big companies missing earnings so horrendously that the unhealthy growth of the last few years is now coming to an end. And two, it tells us that the Federal Reserve and other global central banks are increasingly willing to risk recession or other financial meltdown in order to combat inflation with market panic-inducing rate hikes. Of course, despite the many vocal proponents of cryptocurrency as an opt-out mechanism for the traditional financial system, crypto took a nosedive right along with the traditional markets in light of these events. Now, that's not to say that a decoupling can't and won't happen, but it's not happening yet, at least not enough to say that crypto is a guaranteed win and a safe haven in the short time scale here. Better yet, we actually have some data now to tell us how Bitcoin and crypto and the markets around it will react to a hawkish Federal Reserve, because we've already had a rate hike this year in 2022. If you recall, in the months ahead of that first rate hike of 25 basis points, there were some of the most turbulent months for crypto that I've seen in a while, bringing Bitcoin back into the mid 30Ks at the height of fear back then. If you recall, many were screaming to buy the dip after the all-time high at the end of 2021 and all throughout the choppy market conditions ahead of that first rate hike. Nowadays, the Federal Reserve is signaling a 50 basis point rate hike or more being on the table for May's meeting, which has sent markets that have already been on a razor's edge into even more of a frenzy of fear and uncertainty. And I'm not saying, we can expect 20K Bitcoin in May and all hell is going to break loose, but what I'm saying is that the future for crypto and the traditional markets are far from certain. And the echo chambers that get created on Twitter and YouTube and other social media can cause everyday investors to make grave mistakes in times like these, times exactly like these. We saw it in 2018, much simpler times back then, to be honest, and it will happen again. And the mistake is this: getting sucked into the buy the dip mentality that crypto is just one good thing away from shooting back up to all-time highs. The biggest names in the crypto space will shout from the rooftops to buy the dip whenever Bitcoin or crypto takes a dive. And that causes others to dive headfirst on the premise that this is just a dip and it's going to turn around. Here's the problem. The dip doesn't always result in a resurgence back in the short term, and that dip can continue and continue to chop for months and even years. So then what? Here's the truth. Many of the people who say to buy the dip are people who got their Bitcoin or their altcoin of choice or whatever coin they're talking about at ridiculously low prices. So even if the market sells off deeply, they're still in profit. That, or they have no problem holding that coin at a loss if things go south. They can afford to do that. And not everyone's in that position. To drive this point home about uncertainty and the dangers of following the hype boy pack mentality, as recently as earlier this week, we saw euphoria and calls for bull runs and moving back up to 50K because Bitcoin broke back over 42, 43K. And now here we are under 40K for Bitcoin with fear abound about rate hikes and risk of further downside. That's why it's so dangerous right now in crypto and taking advice like buy the dip, because it's no more than an empty platitude. Every dollar, pound, euro, whatever you spend on crypto now better be money you can afford to be without for years to come, because it could take that long to land in profit if things go off the rails, and even that's not a guarantee. Simply the thought of a 50 basis point rate hike rolled off multiple percentage points off of crypto and traditional markets, and that should tell you something about the riskiness of the market right now. I believe that the future of financial markets lies with crypto, but I'm not foolish enough to believe that the correlation between crypto and traditional markets will simply evaporate at a moment's notice. This is going to take time. And as long as we are correlated in this way, crypto will react negatively to things like rate hikes and equities market panic. We are one cataclysmic March 2020-esque moment away from total disaster for a lot of overextended people in crypto. And I'm no financial advisor, so take what I say with a grain of salt always. But I do believe vehemently that it's okay not to buy the dip. It's okay not to feel certain that crypto is going to take over the world tomorrow. Being successful in the market is only possible if you survive in the market. So do what you have to do to take care of your family, to insulate yourself from the uncertainty, and invest long-term in what you believe in a smart way. Now, I know people are going to be in the comments like, Hashoshi, your FUD isn't helping, this is FUD. But my job is to educate and hopefully help people protect themselves in the markets and make good choices. My job is not to pump the markets or ignore concerning signs or risks. The majority of my net worth is in crypto. I have more skin in the game than most people do, but I'm not willing to drag others in who don't know the risks or aren't prepared to weather the storm that very well could come. Now, in other news, Near Protocol, one of my favorite layer 1 networks these days, at least from a research perspective, has just launched its new stablecoin offering in testnet. And this is very interesting. This US dollar pegged stablecoin dubbed USN appeared on the public testnet this past week, unaccompanied by any formal announcement or details from the Near core team. Speculation now is abound that Near's USN stablecoin will be algorithmically pegged to the US dollar with a mechanism similar to that of UST in the Terra Luna ecosystem, whereby the Near cryptocurrency would be burned equivalent in value to the USN issued by users, and vice versa, USN being burned to receive Near. So using USN and Near as sort of a supply and demand mechanism. If these rumors are confirmed, it will almost undoubtedly bode well for the Near cryptocurrency itself from the perspective of adoption and, of course, price speculation in the positive direction as discussion around deflationary Near comes into play. Now, much ado is made about algorithmic stablecoins and the fact that they are not backed or collateralized by an asset that supports its value in reserve. But proponents will argue that while no direct collateral is held in reserve, these algorithmic stablecoins are, in a sense, collateralized by the economic effect of supply and demand wrought from the value of exchange for the cryptocurrency burnt to issue it, whether that's Near or Luna or some other cryptocurrency. Regardless of what side of the fence you sit on with that particular issue of the legitimacy of algorithmic stablecoins, I can see value in both arguments, to be fair. It's an interesting thought experiment to imagine how Near might be taking into consideration the rather public criticism and concern around Terra Luna and UST, and more importantly, how they plan to address those concerns with their own USN stablecoin. Again, this is all speculative in nature right now. We have to wait to hear from the team directly before we know anything for sure about the strategy, and everyone's speculation may be off. But Near is one of the most exciting ecosystems from a tech perspective right now, as well as one with seemingly lots of tricks up its sleeve. So we're going to want to watch this one closely. Now, by the way, I want to briefly mention that this episode of Crypto Over Coffee is brought to you by iTrustCapital, where US-based crypto investors can invest in crypto in a tax-advantaged manner within an individual retirement account or IRA. If you want to add crypto to your long-term crypto investing toolkit, you can earn a $100 Bitcoin funding bonus by signing up via the link in the description below and funding your account. Now, this past week, Twitter was set ablaze after former CEO and Bitcoin maximalist Jack Dorsey took aim at Ethereum by stating that, in effect, anything built with or on Ethereum has one or more single points of failure embedded in it. To put it bluntly, Jack Dorsey basically said that Ethereum was not up to scratch for the Web3 task at hand. Now, people will be rather surprised to know that this time, I don't fully disagree with Jack Dorsey, but not in the way you might think. Now, I'm an Ethereum user. I've built many a thing on Ethereum, and I still do believe in its long-term value to the space. That said, many of those building things atop Ethereum have found themselves a little bit too reliant on centralized services as a matter of convenience, cost, and heck, it works, so why change it? Well, therein lies the problem, because many critical services and tools like MetaMask utilize other services like Infura. And Infura provides APIs for Ethereum and IPFS so that services can do things like broadcast transactions to the Ethereum network or make other remote procedure call requests for different activities they need to perform on Ethereum, basically taking away the requirement for each service to run their own Ethereum nodes. Services like Infura let developers skip the painful and rather costly process of running that fleet of Ethereum nodes with infrastructure around them to handle these requests themselves. But that convenience comes at the cost of a potential single point of failure if that developer isn't putting contingencies in place if Infura were to go down, and many don't. See, Infura went down this past week, and that rendered huge swaths of critical Ethereum tools down for the count because of that over-reliance on services like Infura. Many services and tools were just fine, ones that had backups in place using another alternative at the time when Infura went down, but not all of them did, at least not without intervention from users to take advantage of that alternative. Like MetaMask, you had to go and change the RPC endpoint that you were using. And the point here is not that Ethereum sucks, but it's that there's an issue of over-reliance on single points of failure within lots of things built on top of Ethereum, and it's easily fixable. I've seen lots of developers making a concerted effort to eliminate these single points of failure in their products already, and they can continue to do so. They just need to add contingencies so they're not relying on one service. So it's not the Ethereum protocol that's the problem, and Jack Dorsey may have exaggerated this criticism, but it's not wholly invalid. It is time now, though, for Rational Reactions, a segment on the show where I read headlines from tech and or crypto-related publications and give you my instant rational reaction to what's being read in that headline. So let's switch over to the computer and get started with this one. All right, I'm going to take a quick coffee break as well. All right, so we've got the first story from Cointelegraph, and this is Goldman Sachs reportedly eyes FTX alliance with regulatory and public listing assistance. The reported discussion between the two CEOs of the company happened in March last month at a time when FTX requested CFTC to eliminate the role of brokers in product offerings. Okay, so here's my first thought. I think you're going to see a lot more big financial services companies, big investment banking companies starting to collaborate more with crypto exchanges. And you're going to see this because crypto exchanges and crypto companies like FTX really understand this space. And a lot of investment banking companies do not really understand this space. They understand some of the fundamentals, but they don't necessarily understand how the users work, how the technical underpinnings work. And so it's going to be very interesting to see how big crypto exchange and crypto companies like the Coinbases, the Geminis, the FTXs of the world start to take a role as stewards for these traditional companies like Goldman Sachs in the regulatory conversation, almost acting as consultants in a way. So it's very, very interesting to see. And in particular, this particular relationship is very interesting because there's been rumblings that Goldman Sachs has been preparing several products in the crypto space. So this might be giving credence to that whole idea. So we'll have to wait and see. The next story here is from TechCrunch. Stripe launches crypto support in Connect, starting with payouts for creators on Twitter. Now, I did see something about this the other day, some rumors, and then of course it was confirmed here towards the end of the week that Stripe was going to dive into crypto payments, and they did so with Polygon, I believe, is the network behind it, and they're going to be starting to pay out in rewards for creators on Twitter, which is pretty cool. What's interesting to me, though, is that you would think that Square, the company also run by Jack Dorsey, former CEO of Twitter, which is also very into the crypto space, well, the Bitcoin space, would be doing something like this first. Very interesting. That was my first thought. Stripe is doing this with Twitter, not Block, formerly Square. Very interesting. Maybe I'm reading too much into that, but that was my first thought. The second thing is I would like to see them do more with this. This Twitter integration only works for a very small subset of people, and I would like to see it more available to more people. I'm sure that's the plan, but we'll have to see how quickly that comes to fore. Next story here is from CoinDesk. Lots of pop-ups on CoinDesk these days. I hope they would fix that. Everyone knows about the consensus conference, guys. Okay, so the story reads this. Is Ethereum staking pool Lido's growth an omen of centralization? Lido might be on track to control over 50% of all staked Ether on the Beacon chain. Better it than Coinbase, proponents say. So there's been a lot of concern around the centralization of staking in Ethereum and the idea that if you concentrate too much Ether in one area, particularly ones that are managed in custody solutions or their smart contract-based solutions or exchanges, that you create a huge problem in the security of proof of stake, and potentially you find yourself in a position where you have a lot of Ether at risk. Now, Lido itself is not all bad, right? I think it's providing a service for people that don't want to manage or deal with the process of staking their Ether, and Lido provides that opportunity to earn that yield related to your Ether on the Beacon chain, which is the current proof of stake home. That's going to be subject to the merge soon. So the Beacon chain as the consensus layer is going to be merged with the execution layer that we have today on Ethereum, quote, 1.0. We've moved away from the Ethereum 2.0 and 1.0 terminology and away from the Beacon chain terminology. So the consensus layer is what was once called Ethereum 2.0. It's proof of stake. Now, Lido controlling over 50% of staked Ether, regardless of what anyone says, is a concern. It shows that there are a lot fewer people than one might have thought that are willing to manage the staking process on their own. It also shows you that, in general, people are trying to find alternatives to exchanges, so there's a positive element to it also. My major concern right now is that overall, staking on Ethereum is still very murky. People don't really know how it works or what's going on, what the trade-offs are, how to do it on their own, and I hope that that changes in the future. Hard to say whether this is an omen of centralization or if it's just a product of the fact that it's sort of half built so far. People can't really manage this on their own because it's not very mature right now. I think that's probably what it is, but we're going to have to watch this one and see what happens when the merge happens. Okay, so we're going to now switch gears again, head back over to the main screen and talk about today's 404 Logic Not Found, everyone's favorite segment. Now, that being said, it is time for 404 Logic Not Found, and for those of you who may not be initiated in this little firecracker of a segment, highlight notable tech-related fails or otherwise stupid moves in the world that need to get some attention. And speaking of attention, if you want to help this episode of Crypto Over Coffee get some attention from the algorithm robots, please hit like, get subscribed, follow the podcast, share it with your friends. It tells the robots that control this whole show that you're enjoying the content, and others might also. So, of course, thank you for that in advance. And to all the people who say you don't drink the coffee, I'm always just so focused on talking, but here you go. There we go. So if we throw 404 in the time circuits and fire up the flux capacitor, it will take us right into a live debate on the global economy between the International Monetary Fund, or IMF, and global central bank representatives. And I honestly could not quite believe my ears when I was listening to it. Now, there were highlights and lowlights, things I agreed with and things I didn't, just like any live presentation. And heck, I've been there. But there was one moment where the IMF director said something to the effect of, "We recognized there was too much money in circulation and not enough goods, and we didn't think through the consequences up front that would have informed better decisions." And this was all when discussing monetary policy decisions, in recent past. I mean, I'll link the whole video and the snippet that I'm talking about so you can draw your own conclusions and you can listen to it live because I'm paraphrasing, but I had to pause and ponder that one for a second. How can you not realize the consequences of what's been going on in the global economy, i.e. printing tons of money and propping up the economy artificially? Anyone with a high school education and a bit of a knack for the game of cause and effect would know that you cannot print money into oblivion to prop up an economy and expect anything but rampant inflation. You should also realize that it's very questionable to admit that those in charge of some of the most consequential decisions in the global economic front did not fully understand the consequences of their actions before taking those actions. I mean, what? Now, I'm no Nobel Prize winning economist. That is very clear. But I can tell you that I am very well aware that my $1 bill in the early 20th century would have bought me a nice quality dress shirt. And now that same dollar bill will barely cover a burnt-ass coffee from McDonald's that tastes like melted truck tires. That is, if the sales tax doesn't put me over $1 and I can't afford it after all. I mean, in 1975, today's valuation on the dollar was equivalent to $5 back then. This is not a new issue. This is not some magic unforeseen force that has been acting surreptitiously in the night. Either the economists and policymakers were frankly too naive and or foolish to understand this fact, or they knew this fact and chose to ignore it. And either way, we bear the consequences as a people, and not just in one country, but around the world as a collective. We're paying for this. That right there is a 404 logic not found in its own right. But the biggest illogical element of this whole thing is that many of those closest to the irresponsible decision-making of the last century have been the ones presenting the least in the way of solutions to the problem. The bottom line is that the people most affected by the lackadaisical monetary policy described here are the ones who have the least ability to influence change on said monetary policy, and that needs to change. Everyone should have a say in this space, not just a few people. All right, folks, let's go ahead and shift gears again and do some community Q&A. I always answer questions from folks who watch the show, and I've got some questions from last week's episode that I'm going to answer. And I want to remind you that if you have a question that you would like answered, please leave them in the comments down below on YouTube, or you can tweet me at Hashoshi4 as well. Okay, so let's go ahead and dive into these questions. I'm going to pull them up here on the computer, and we'll see what we've got today. Okay, this first question is not even crypto related, but it's related to my channel, so I figured I would answer it. This is from CSipes 1983. So if people are scamming all the time in the comments, how are we to know when the real Hashoshi contacts us for a winning draw? So for the random keystone draw. That's a great question. Two things to look out for to know that it is actually me commenting. Usually if I'm commenting something important like that, I will leave a heart on the comment, on your comments. You'll see a little heart from me and my icon. No one else can do that except me, the real me. Two, you'll see the verification check mark and my name will be highlighted. Hashoshi will be highlighted when I comment on your comments. So you'll be able to see, even if there's an impersonator in the comments asking you to contact me on WhatsApp, my comment will look different because I'm the channel owner. So just look out for those signs: highlighted name, verification check, heart on your comment. Those are only things that I can have and that I do in the comments. Cool? Good question. Next question from Bob Pilling. Question for you for your Crypto Over Coffee show. Can you explain why TPS, or transactions per second, isn't a fair metric to apply to eUTXO blockchains or UTXO blockchains such as Cardano and Ergo, etc. I recently saw an interview where Alex Chipernoi of Ergo said they had 15,000 outputs in a single transaction, for example. So you actually started hitting on that. There's a lot of comparison one-to-one of transaction per second throughput numbers between account-based blockchains and UTXO blockchains or unspent transaction output blockchains. And they are a little bit misleading because in unspent transaction output based blockchains or extended UTXO blockchains like Cardano and Ergo, there's a lot of latitude for parallelizing and bundling transactional functions, right? To bundle many outputs into one single transaction body. And the reason for that is because of the way that unspent transaction outputs work. When you are putting in outputs from previous transactions as inputs to new transactions, which produce further outputs. It's a very interesting sort of transitive check and balance system, or balancing the scales. Your inputs are always going to equal your outputs, but you can bundle all of those. And so you can get a lot more out of one single transaction than you can in an account-based blockchain like on Ethereum. Now, there are limits to this, of course, because you have transaction size, you have, if you're using smart contracts on something like Cardano, you have script memory capacity limits. You also have actual just script size capacity limits. So it's not just this unlimited bundling. And a lot of the 15,000 outputs in a single transaction type of things are done in environments that are tailored to get the maximum out of one transaction. Okay, so take those measurements with a grain of salt, because in reality, in practice, on the mainnet, you may not see transactions being used that way. But that is totally true. TPS is a fair metric, but you need to adjust for bundling. So it shouldn't be transactions per second just as a transaction validated on chain with a TXID. It should be number of operations completed. So number of state changes, or number of executions, or number of recipients from for outputs, for example. That would make it a little bit more fair of a comparison between the two to account for bundling that happens in UTXO-based models. Thank you for your question. Next question is from Rock Guitar Modes. Do you think that a blend between decentralization and centralized control is going to be vital for corporate adoption of dApps or decentralized applications? I'm thinking particularly of manufacturing corps that need tight control of supply chains in order to build things. I think that in the future, all of these things are going to be controlled in many ways on public blockchains. I think we are going to public blockchains. There will be always forces of centralization, that is to be human, but what you're going to see is privacy technologies and secure technologies, zero knowledge proofs, for example, are going to be used to make these sort of companies that need some degree of privacy comfortable operating in a hybrid public sort of federated blockchain environment. So you might have a layer 2 that is dedicated to a manufacturing organization, but they're still writing data to that public chain because you need to get that cryptographic verifiability and finality that you get from the public chain. So to answer your question in short, there will always be this push and pull between centralization and decentralization, but the companies that really capture the value of blockchain technology and cryptocurrency are going to be those that adopt public blockchains to achieve the practical benefits of decentralization. And they can use technologies like zero knowledge proofs, etc., to protect the privacy of their data and the sanctity of their data as needed. I want to thank you so much for asking questions on the show. Reminder, if you have a question that you want answered, make sure you ask it in the comments or send me a quick message on Twitter. Now, I want to thank you so much for watching this and every other episode of Crypto Over Coffee. Hope you and your family have a wonderful rest of your weekend and week ahead. And if you have some time to stick around, I will link up another crypto video right here somewhere on the screen for you to click. Got tons of content on the channel already and tons on the way, so make sure you are subscribed. Thank you so much again, and until next time, cheers.